So hello friends, welcome to my channel MN Coaching Center. So today I'm going to explain you that is the accounting standards, concepts, objectives, and so last video I stopped here in AS11 effects of changes in foreign exchange rates that was revised in 2003 by 2003. So an enterprise may carry on activities that are involving some of the foreign exchanges in it may be in two ways: by transacting in foreign currencies, by trading the foreign currencies, or by indulging in foreign operations. In order to include their foreign currency, in order to take the foreign currency transactions and foreign operations in the finance statement of an enterprise, the transaction must be expressed in the terms in the enterprise reporting currency. It should be expressed, and the financial statement of the foreign operation, the financial statement of the foreign operation must be translated into the enterprise reporting currency. It should be translated, and the standard dealing with the issues involved in accounting for foreign currency transaction and foreign operations that decides which exchange rate to use and how to recognize the financial effect of change in their financial statement is called as the standard. That standard deals, and the standard requires some of the enterprise to disclose their amount of exchange difference in that will be the net profit or loss of for that period, and the amount of exchange difference, the difference or loss. These all the things it contains. Next is AS12, that is accounting of government grants issued by 1991. So AS12 deals with the accounting for government grants and it tells us that the government's grants should not be recognized. The government grant should not be recognized until there is reasonable assurance. That the enterprise will comply with the conditions. They will follow the conditions attached to them, and the grant will be received. The government grant will be received. And the standard also tells us about the treatment of non-monetary government grants and the presence of grants related to their specific fixed assets and that are related to the revenue, related to promoters contribution, treatment for refund for government grants. Next is accounting for investment, that is issued by 1993. This deals with the accounting of investments in which financial statement of an enterprises that are related to disclosure requirements. They are related for the disclosures requirement, and the enterprise are required to disclose the current investment. They need to disclose the current investment and long-term investment. They have to disclose distinctly in their financial statement. They have to disclose these things, and an investment property should account for a long-term investment. For long-term investment, they should do the investment property, and the cost of investment should include investment should include some of the things like acquisition cost and on disposal of investment. The difference between the amount and net disposal should be charged or credited, and then they should be given that amount should be written in profit or loss statement. Next is accounting of amalgamation, that is issued in 1994. So AS14 that deals with the accounting for amalgamation and the treatment of an resultant will or receivers, and is directed principally to companies. Although some of its requirements also they have some of the finance statement of other enterprises. And amalgamation may be either in the nature of merge or purchase. It may be in nature of merged with company, or that it may be purchased. The standard species, the conditions to be satisfied by an amalgamation to be, it is considered as the amalgamation in nature of merge. Next, an amalgamation in nature of mulch is accounted for a per pooling of interests method, and in nature of purchase is dealt under purchase method. And also the standard also it gives this information about the disclosure requirements for both. It may be amalgamation, both types of amalgamation. In the first statement there are two types of amalgamation, employment's benefits, that is revised by 2005. In this standard requirements, the enterprise requires the enterprise to recognize it makes enterprise to recognize a liability when a employee has provided services in exchange for employee benefits that should be paid in the future, and an expenses when enterprise consumes the economic benefits arising from services that are provided by an employee in exchange for their employee benefits. In exchange for their employee benefit, they will give services to employees. Next is employee benefits. There are two types: short-term employee benefits that are like wages, salaries, and post-employee benefits that are gratuity pension. Next is long-term employee benefits like long-term leave, long-term disability benefits. Next is termination benefits that are PRS payment. These are some of the payments that are given. Four types of benefits that are given to the employee. Next is borrowing costs that are issued in 2000 year in the year 2000, and the standard tells us about the treatment of borrowing cost incurred by an enterprise that is connecting with the borrowing of funds. Standard it deals with the issues that are related to definition of asset which qualify for capitalization of interest, determination of the period for which interest can be capitalized, and determination of the amount that can be capitalized in that year, and the amount that can be borrowing costs eligible for capitalization should be determined in accordance with provision of AS 16 and other borrowing costs. Next is should be recognized as expenses in the period in which they are incurred. In the period in which they are incurred, they should be recognized as the expenses. Segment reporting that are issued in 2000. This standard requires that the account information should be reported on segment basis. The account information should be on the basis of the segment, as AS 17 establishes it has some principles for reporting financial information about the different types of products and services in that enterprise, and the information that will help help users of the financial statements to better to understand their performance of that company and what are the risks taken by the company, and for the judgment about the judgment by the enterprise in the whole. And this standard it may have some of the risk and returns or diversified or multi-national enterprise. These are which may not be determined, they may not be determined from the aggregated data. Next, related party disclosure. It was issued in the year 2000. These standards that prescribes the requirement. It tells us about the requirement for certain disclosures. It tells us the requirement which must be made in the financial statements of the reporting enterprise for making the transaction between the reporting enterprise and its related parties. Next, the requirements of the standard apply. It applies to the financial statements of each reporting enterprise. It tells us about the financial statement of the each reporting enterprise, has also consolidated financial statements that are presented by the holding company, the present company. What are the financial statement? Since the standard is more subjectively, particularly with respect to identification of their parties, obtaining corporative evidence, it becomes more difficult for the auditors to do this. AS 19, that is lease. It is issued in 2001, and it tells us about the amount and disclosure that are required for both financial lease and operating lease in the books of the lessor and lease. The classification of lease adopted in this standard, it is based on the extent to which risk and rewards incident to ownerships of a leased asset that lies with the lessor and lease. So a lease, it is classified, it is a financial lease if it is transferred, substantially with all the risk and rewards incident into the ownership. An operating lease is a lease other than financial lease. At the inception of this lease, assets under financial lease, they are capitalized in the books of lessee with the corresponding liabilities for lease obligation, as against the operating lease, wherein lease payments are recognized as an expense in profit and loss account of systematic basis over the lease terms without capitalizing the asset. The lessor should recognize receivable at an amount equal to the net investment in the lease in case of any financial lease, whereas under operating lease the lessor will present the leased assets under fixed assets in his balance sheet besides the recognizing the leased income of the systematic basis over the lease term. Next is AS 20, that is the earning per share, that was issued in the year 2001. So this objective of the standard, tells us about the principles for determination and presentation of earning their per share, which will improve their comparison of performance, that will improve their performance in the different enterprise for some period, and among different accounting periods it may, for the same enterprise, it may make some differences. And earning per share, EPS, it is a financial ratio indicating the amount of profit or loss for the period attributable to each equity share. And AS 20, it gives us computational methodology for determination and presentation of their basic and diluted earning per share. To know about their information about their per share, it gives us information about their per share. Next is the consolidated financial statement, that was issued in 2001. AS 21, that deals with the preparation and presentation of consolidated financial statements with an intention of providing some of the information about their activities of the groups, and consolidation financial statements that are presented by the parent holding company to provide some of the financial information about their activities in the happening in the economy. And a parent which presents the consolidated financial statement should present their statement in accordance with the standards of separating their separate financial statements. Investment in subsidiaries should be accounted in this in the as 13. Accounting of taxes on income, issued in 2001. So it tells us the recognition the taxes on income as it is calculated as per the books of account, with the actual taxes payable on the taxable income, the income they get taxes payable as per the provision applicable to the entity for the time being in force. The standard that prescribes the accounting treatment of taxes on income and follows the concepts of matching expenses against the revenue for their period of time. And these concepts of matching is more peculiar in cases of income tax, since in a number of cases the taxable income may be significant different from the income reported in the financial statements due to the difference in treatment of certain items reflected in accounts.